Welcome back to episode 24 of the Backholder Pod. And as always, don't forget to smash that cute little like button because it's always your support that keeps us going. So I think in the financials market, it gets even more interesting by the day. So at first, we talk about Silicon Valley Bank. And then after that, we start looking at other second tier banks started going to go default. And then now, one of the critically important banks out there in the European region, Credit Suisse, is also on the brink of bankruptcy, and UBS is even attempting or already has gotten approval to acquire them. So Bunti, maybe you can just share a little bit more on what exactly is transpiring now and what's going to happen to the financial market. Are we all just going to sell our investments or what's going to happen? Is 08 coming again?
Yeah, I would say stay away from bank stocks. Yeah, I just come back to Credit Suisse. This is a shotgun marriage between Credit Suisse and UBS, and UBS isn't. They don't even want to buy Credit Suisse, but they kind of like forced by the regulators to come into these transactions to acquire Credit Suisse. So Credit Suisse didn't go bankrupt; they just acquired. So I think UBS will assume both the assets and liabilities of Credit Suisse. So this happened during the weekend, and then just on Monday it was announced. I think it's the deal. I think the terms of the deal are kind of like finalized already.
For this deal, right? I think you made a video explaining it. I'm still a little bit lost. Can I just check with you, right? Basically they say wipe out bondholders, right? And then the bondholders are thinking of taking them to court. So taking who to court? May I ask? Taking Credit Suisse to court?
So the situation now is that, Credit Suisse, they have a lot of problems. Their problem is not the same as those faced by SVB Bank and so on. So they are entirely different. But to cut it short is that the bank didn't run basically it's run very poorly. And now their capital situation is in danger. And I think the Swiss regulators, they don't want to let this continue. So they just say, okay, it has to be acquired by another bank, which is the only one that is able to do so is UBS. So what happened is that at UBS, they announced, I think something like $3 billion to acquire the shares. They paid with their own shares. But then when it comes to these bondholders, right, this is a very specific asset class. This is what they call the AT1, additional tier 1 capital. And this tier 1 capital would basically just wipe out. And what happened is that this AT1, right, is that I think it was only invented since it's after global financial crisis. It was created with the purpose of absorbing loss in the situation of insolvency. So it's like if you read the clause, right, it says that, okay, if certain threshold is crossed, then it can write down like to zero, even without conversion to become equities. So it's very specific asset class that is quite dangerous, but the market kind of ignored them for very long, and now suddenly it just wake up that, oh, wow, how come can like that just write off become zero? So they're very angry. So they try to bring to court.
Did Credit Suisse breach that level that was specified?
Yeah, this is the part that is quite, I myself also quite confused because whether it crossed or not, we don't have real-time data to tell us where is Credit Suisse now. But I think if you read the clause, right, basically the regulators, I think it's FINMA Swiss regulators are basically, they can make the call to say that, okay, this is non-viable anymore. Like you already crossed. They can declare that essentially.
So they actually randomly mark to market like, okay, I decide that you're no longer solvent, even though you may still have some asset able to back it up.
Yeah, this is hard to say. I think it's just that, the entire thing is very strange because we call it bonds, right? Usually bonds, in terms of like claims, they will rank before the common shareholders.
Yeah.
But in this case, they kind of like, okay, common shareholder get something, but these bondholders, they just get nothing. So it's very strange. But if you read the clause, you will understand that actually, I think Swiss regulators, they are right to do that. They have legally, they are okay. It's just that in terms of market practice, it's a bit weird, like quite hard to make sense of it.
So from the article that you sent, right, I think I read one article that says that other banks, they also have this AT1 thing, like cushioning their tier 1 capital requirement. So my thought was, if I'm a bond holder of those kind of bond, right, I'll definitely dump those bonds straight away.
Yeah.
And then I think the FEMA come out to say that, hey, don't worry. This is like only Credit Suisse is the bugger. The rest we won't do this kind of.
When they tell you to don't worry, you better start to get worried.
Yeah,
because that's how
precisely. Precisely. So the thing is like, how safe are the rest of the banks? Like
This AT1, right? I think in total, I read some articles, headlines at least. They say there's about like 200 plus billions in total.
250.
These are usually banks capital. It's very specific to bank. And for Credit Suisse, I think 17 billion. I forgot which currency already, but kind of like in the magnitude of close to 20 billions just wipe out. So what happened is that I think for AT1, for the other banks, right, depending on what's their credit rating, I think the value compared to 1 or 2 weeks ago might drop like what, I think 10 to 20%. Just because they realize that, oh, actually my bond can wipe out like this one.
Hey guys, do you know what's a good broker to buy stocks?
Oh, I know, you can use Moomoo.
Why?
Moomoo got low commission, so you save a lot on trading fees.
not only that, they also let you easily keep track of the company's news and announcements.
Oh yeah, they also let you easily analyze companies from both the technicals and fundamentals to help you make better decisions when investing in company.
Wow, so good. But they got give sign up rewards or not? Or any sign up fees or not?
Got. For the first reward, when you deposit $100, you get $2 cashback daily for 10 days.
And for the second reward, deposit 2K and perform 2 buy trades to get a free Coca-Cola stock worth $80.
And the ultimate reward, deposit 10K and perform 7 buy trades to get a $108 cash coupon.
Wow, so good. So if you're interested, you can always sign up with the link below. And as always, thank you, Moomoo, for sponsoring this video.
Yeah.
Actually, I wanted to ask Kelvin, right? Because I think Kelvin has also been doing some research and even has been covering the SVB side, right? So now we keep looking at one by one, it starts getting like this idea of contagion. Oh, one bank leads to another and another. Then you talk about US and then suddenly it goes to Europe. Actually, Kelvin, do you think this is a contagion? Do you think there will be more and more banks that's going to be affected in the near upcoming weeks or anything?
I won't be surprised. First thing is that AT1 bond contagion, right? I think all the dangerous banks will all be affected. I think HSBC was affected yesterday, or at least their bonds, not their company. DBS looks safe, hopefully. But I think it's again like the whole crypto thing all over again. All the weak banks will be wiped out. Hopefully not.
I think not only that. I think I also read some news. I think even Buffett was talking to the Biden admin like 2 or 3 days ago. It was on the headlines saying like he was just discussing about the banking crisis and how maybe Berkshire can come in and help because they have like $100+ billion on their balance sheet doing nothing. But I think this comes the idea of like being opportunistic, right? So Buffett has always been the type that comes in and then he kill cheap because he can structure a very interesting deal. Because when people are desperate, they need money, and then Buffett has the money, but he wants a lot more. That's how his returns are always so high. So then I wanted to circle back to Bunti, right? Bunti say just don't touch banks. Would you be surprised? Actually, I'm going to throw it back to Bunti. Would you be surprised if Buffett steps in and he starts acquiring like massive amount of bank shares or bank equity?
Actually, if you look at what Buffett did during 2008 and 2009, I think he invested in Goldman Sachs and a couple of other banks. The type of investment that he did, right, is very special. Right? It's almost like tailor-made one. So for him, because he know that what he has is like, the cash, a lot of cash, 100+ billions. And then he also know that he has the reputations. So what he can do is just, he can say, okay, you want my money? I can pump in 5 billion, 10 billion, 20 billion to you. And then I put my name on it. And then I want to structure a deal such that, okay, if there's anything wrong with the banks, my claims come before you guys, like all the common shares. So he last time he invested in preferred shares. He's not really a common shares. So you need to look at the deal. Some of the deal is like, okay, how can he get such a good return, like preferred shares with good coupons? But actually his risk is like behind others. But only he can do that kind of deal, and it's very attractive for him because people need his money and people need his reputations. So that's what happened. I want to circle back to just one comment from Eric. You mentioned about like some other regulators came out and say something about the AT1, right? Actually, just to clarify, FINMA or the Switzerland regulator is the one that say, okay, now this Credit Suisse AT1 wipe out. And then it was, I think, European regulators. I don't remember what's the name already. Basically, it's like the ECB and European regulators that came out and say, okay, the other banks, your AT1 is fine. we will respect the, the seniority of the claims. So basically, they are telling investor, don't panic selling your AT1 bonds. So you can see that even within Europe, right, Switzerland is kind of like doing things that is quite odd, and which is different from the stand of other European regulators. So that's the situation.
But Eric, are you currently scared? Are you scared of this whole contagion thing?
No, I am, as you can see, I'm very hot today, very red, because I'm not scared, I'm holding DBS, not scared at all. In fact, I praying for it to come really low so that I can kill some cheap stock. But that aside, I think if you are a bondholder, right, imagine if you guys hold AT1, right, would you be comfortable still holding it? I just want to see what are your reactions to it. Would you all hold it, Kelvin? Would you continue to hold it? Will you be assured by them?
Depends on the bank. If it's, wow, it's hard to say. It also
Like
depends
if you're
on,
European, if you're like, imagine yourself,
sell
you're
already.
Angmo.
I will sell, man.
You will sell, right?
Yeah.
Kicking, what is your response? Would you hold it?
I think I wouldn't even have it in the first place. But let's assume
Okay. Just imagine that you have it.
Right. I'll sell it also. If I'm in Europe, that basket of equities.
Yeah, I also think that it doesn't make sense to hold it. That's the things, because suddenly you realize that your claims is like even behind common shares, So it doesn't make sense, right? For that additional few percent spread. Say for example, right? I don't know what's the rate of all these preferred shares. Say for example, if you own a banks, you get, let's say, 8% dividend. Okay. But for this AT1, even though it's like a preferred shares, right? Let's say you get 12%, additional 4 or 5%, right? You need like how many years? 10, 20 years to just, double your money. And then that's how I mean, it doesn't make sense. Basically, you just like, you need a returns that is a lot higher to make sense, to make the investment, logical. If not, it's like, okay, how come when there's losses, they are the first to take the loss?
The risk reward don't make sense. When there's this new introduction. I think initially when it all started out, it kind of makes sense. Like the framework is still passable, I guess. Then when this whole thing flipped on itself, then I guess people start throwing it away.
Sorry.
I have another question to ask you all. Saudi, they just invested the money into Credit Suisse. I think like Q4 last year, about October or November. Yeah, they get become the largest shareholders. And now, like within a couple of months, right? Not even like 6 months. Now their capital it's not like wiped out. They still get proportions of that, 3 billion and something, but still a huge capital loss within such a short period of time. If you are Saudi, right, what will you feel like will you like straight away unfriend the entire
But I don't need to worry. My money printer is at the back of my bag. This one
doesn't mean that you are okay to lose money. Make you look very stupid, right? Don't you think so?
Yeah, I can see.
Okay, so just now I was saying about this, the federal banks, all the central banks are coming together to set up this joint liquidity operation. But it's quite funny because this whole thing was triggered by US in the first place. Then now they are trying to like, hey, you help me there? You help me, that kind of feeling. So I think it has gone from just raising interest rate to fight inflation, which was created by the Fed themselves. So now there's caused this whole situation, affected the Credit Suisse and other countries. Then now they have to seek help from everyone else. And if this continues out of hand, the next step would probably be this something called special drawing rights. It's basically like the International Monetary Fund. I think it's sort of like a bank account for where everyone deposits their money into it. So this would be the last backup plan if the contagion spreads, this whole financial crisis spreads. But enough of fear mongering.
Actually, I don't know what this SDR thing is. So can you explain a little bit more on what it does, or what will kick in, or what will trigger this?
Actually, I don't know what is this. As in, it is like how to say, it's like a currency of the IMF. Okay, so but that's the name, but we haven't seen them like operate during the crisis. So you don't know how and how much power they have. and whether others are happy when, let's say, IMF step in and so on. But there's this claim to say that, okay, the next big crisis, IMF will have to act. The reason is because if you look at Federal Reserve, their balance sheet is like super big already. Same for ECB, same for BOJ. But IMF balance sheet is the only one that still like looks clean. So if they print SDR and then just like come up with assets and do bailout and so on, so there's still capacity for IMF to do something. But how they act, all these things, the mechanism and so on is like, first, could be complicated. Secondly, is that we never seen how it acted before, because it has never acted in a big way. So it's very hard to like project what kind of actions that they can come up with. I would say this is unknown territory.
So even during the great financial crisis, right, 0809, we have not drawn on this.
Yeah, it is like they're not doing much.
Maybe it's just there, no? You know, it's just there that say, oh, we have this, you know, nuclear warhead.
Maybe you open up inside is crypto.
Yeah, maybe it's nothing inside. That's what I'm saying. Maybe it's just like,
if you think
idle head, like figurehead. It's not really anything.
You think about it, it's nothing one. It's just an organization that is like consider the shareholders are all the big powers, right? US, China, Europe, and so on. But they are starting up from nothing. It's like you give birth to a new Bitcoin, something like that. And basically, it's just a clean slate of balance sheet. I'm not saying IMF SDR is new. It has been there for very long. It's just that it has never been used in a big way. Like you look at the balance sheet size of Federal Reserve versus ECB versus SDR. SDR is like almost not in size, but they can do it, right? Because everything, all this, when crisis hit, is all about confidence, and you might lose confidence on single US, but when US team up with Europe, team up with all these big economies, they form this IMF, like a world central bank like that. So when they say they act, right, so you have more trust, right? Because it is like a bigger organizations. But how all these decisions are made, right, is like opaque as of now, because we don't, like, not many people know how they operate, I would say. But there are books there telling stories, like almost like conspiracy. Those I don't want to mention now, but you can read about it. Quite interesting.
We look at this whole thing transpire, and then just now Kelvin used the word fear mongering, right? Then on YouTube the thumbnail, wow, one getting more scarier than the other, like the face getting more and more scarier. But then quite interesting, if you pull back out, right, on a year-to-date basis, if you just look at the US market, right, I think S&P is still up like 5%, if I'm not 4 to 5%. And then it's trading between the 3,008 to 4,001 points, and then it just keeps going. I mean, it essentially went sideways. Like it did a strong recovery, and then it came back down, and then go up, then come back down again. So now it's still recovering despite all the noises that is happening in the markets right now. That's whatever that's going on, and then whether there's the risk of contagion or not, let's not talk about it. But I think back to the point, right? Actually, Kelvin, why do you think the market is still holding up so strong? Like why people don't seem to be scared of these issues?
The Fed is going to have announced their interest rate hike by Thursday, tomorrow morning, I think around 8 or 8:30. So it's trying to price in a 0% rate hike. Probably that's why the market is trying to price in this kind of money printing environment. I think the Fed is more or less like forced to not raise interest rate tomorrow, even though they actually have to. So it sort of pushed this whole inflation thing aside. They say, oh, we have to solve this banking crisis first. Then maybe it will cause even bigger inflation later on, because there's this whole money printing going on, right? Though I think some of you may think it's not money printing. Personally, I don't really know how this whole Fed balance sheet going up works, how it actually contribute to inflation. Do any one of you know?
I think Bunti had a discussion in our group just now about whether this is QE or not QE.
25 basis point hike. That's what Fed will announce, at least for the upcoming FOMC meeting. But in terms of whether it's QE or not, I think sometimes people tend to mix up all these different concepts. I think QE is a very specific concept. It is like Federal Reserve step in to say, okay, I saw all these assets available on the market. I just buy, and I increase my balance sheets, right? So that's QE. But what is happening right now with, let's say, like the BTFP thing, it is not like Fed step in and buy assets, right? They're just extending loan to all these banks. So they take in collateral, they pump money out, but it's not buying assets, it's doing lending. So in terms of mechanism and in terms of the purpose,
the money they lend out, somebody is going to be at the receiving end, and somebody has to do something with the money, right?
Yes.
So I think a lot of people is presuming that it's just an additional step where the end consumer takes the money and then they go and buy assets again. That's why they're pushing the market.
That's why I said you need to look at specific concept and know what is the mechanism, what is the intentions of doing that, and then you can differentiate what are these two. For example, I can ask you, like, is apple fruit? You say yes. Then is orange fruit? You say yes. I tell you apple is orange. So makes sense, right? So you see, same for these QE things, like both QE increase money supply, and when they do lending, also increase money supply, and hence QE same as lending money out. So it cannot be the same, right? I mean, concept is different concept already. It's just that they have similar effect, at least on the short term. That's why people tend to like, oh, I don't care, I group them together, though. This is the QE. Or I can say the apple anyway will turn to become orange soon. Okay. If you want to argue that way, I think
no,
fine.
apple and orange will 烂掉, and then both will become fertilizers. That's
No
how
lah.
they end.
At the end of the day, apple and orange, after you eat them, they become fiber and then they become poop, right?
It's the same.
They are the same outcome. That's what we're saying. We only care about the outcome.
Yes,
Nobody cares about the mechanism.
Yeah. Then it's the same.
Yeah, it's the same, right? Like, at least in the short term. I don't know how long is their short term lah. Because I'm now looking at the Fed balance sheet, right? It does show a very sharp spike after like since last year around April that time, they started tapering. March to April that time, they taper until, and then the March, right? What the thing chong like, man, it's like a almost vertical increase. Yeah, so I don't know how updated is this. I think probably the last update is like 14th of March. Yeah,
They update on a weekly basis.
Weekly
Every
basis.
Thursday, our time, you will see a new update.
I
But
think it'll be even
the
more.
size of the balance sheet is not equal to QE. That what I'm trying to explain there. Because if they extend lending, right, also they will see an increase in their balance sheets. So the entire equation is kind of complicated. I don't think many people can explain it in details. So we tend to simplify and tend to oversimplify until everything is the same. Yeah.
To me, my interpretation is like, if there's liquidity in the bank can lend more money, people can borrow more money, and that will just create inflation. That's my simple understanding. So liquidity up equals stock up, according to some experts. But I guess when you compare the chart of liquidity versus the stock market, right, it has a bit of correlation. So I guess everyone is bullish again now.
But actually, just now, Kelvin also did mention about the idea of stagflation, right? So I think a lot of people like to draw comparisons between like 70s and now, like what happened in Volcker, where the recession plus inflation, and he decided to just pump the interest rate up so that he tried to curb down the inflation first. But then now you can kind of argue that whether we are in a recession or not, we don't really know. I mean, it's still playing out in real time, but we're just all trying to guess, right? But before the recession even come, because I think officially it's not even recessionary yet, but then the bank crisis now happens to take precedent over the recession issue. So I just wanted to kind of understand, like, do you guys think which one is probably more serious, or which one will you try to solve first? Like the idea of solving the bank confidence portion, or the inflation problem, which looks like it's going to be kicked down, like it's going to be a can that's going to be kicked down the road. But the Fed seems to have already made a position. Then I think what about Kelvin? What do you think?
The bank thing first. I think banking, if the banks were to collapse, I think the entire economy can collapse. So you have to solve that first. Inflation, it's nothing new. We have been to like 10% in the past. This 6% is nothing new. We can just kick it down back to next year, only solve, no problem. By then, maybe like 15%, 20%.
Right.
Imagine what's the housing interest rate next year.
I do agree that the banking crisis is quite important though, but inflation is actually a tax on the poor, and it's a very huge tax. So if it's a prolonged kind of tax, right, I think it's gonna create a lot of social unrest also. So that's just my own idea. What about Eric?
I'm thinking about this, right? I think that if we think a little bit further down, right, it seems that we are normalizing the 4 to 5% interest rate already. Like, people are getting okay with it. Employment is still strong. So maybe I can provide an analogy. For example, right, this banking crisis is akin to like a heart attack, and then your inflation is like diabetes or high blood pressure. So you are taking medication, but suddenly you have a heart attack. Obviously, you deal with the heart attack, right? Because if you don't deal with the heart attack, you die lah, basically. So like it's the same like what Kelvin said, right? Banking crisis is urgent plus important. So we deal with that first, and then we kick the inflation thing down the road. And what I think will happen is that most likely we'll see like Federal going to increase the interest even more. Because once they kick that down, right, the inflation is going to continue creeping back up. Then you say, no choice lah, we got to cure the heart attack first, ma. So you cure the heart attack, and then the thing go back up again, and say, oh my goodness. Okay, so now heart attack solved already.
But then I will come back, right? Because this story, the narrative that you're painting now, right, is what they exactly did for the China disruption. So there will always be a heart attack issue that comes in, and then they say that, okay, I need to settle this thing that's important, then they kick down. Yeah. And then they hi, then something break again. Okay, this one's important, then I stop again. So I don't know, man. I don't know when this whole thing will stop, but it feels very much like, I mean, the Fed has been wrong, and it will continue to be wrong, and we all just try to learn along the way.
I think we won't stop. I think if people, if you are reading the Fed correctly, right, they basically have no chill lah. They just want to do what is majority thinks that is the correct thing. They won't go against like the majority, right? So the majority say that, now we have a crisis, you better step in and stop increasing your rate. And that is exactly what they will do in the short term, at least. So
you think it's 0% tomorrow?
It could be 0, it could be 0.25. Either way, I tilt a little bit now, right, towards the 0. I'll be quite surprised if they put 0.25. That was my expectation before this banking thing. So now with this banking thing, I think they will not have the guts to push interest rate up, because you are adding to the heart attack.
What about Jiking?
I mean, I follow Bunti lah, because I look at the table, and then I see it should be 0.25 lah, based on expectations now. So if they really announce 0 today, then I guess the market will like everybody will just keep pushing it up again.
Already started.
I still remain relatively bearish in the previous video. I think there was once in a few episodes ago, I did make the bearish stance or bearish call, and then now the Fed suddenly pivot on, they changed their stance. I'm still in the assessment whether I'm gonna change my opinion or not, but I still do think that this whole thing that's playing out now is too confusing, too much noises. I'm not gonna adjust anything. If you got money, I'll just continue buying. That's about it. Like, yeah, I honestly don't really have a very strong market opinion now. I'm just confused.
I'm on Bunti's side also. Right? I think they will raise by 25 basis points. From my whole understanding, this whole crisis was caused by the Fed raising rates too fast. So if you have been raising 25 basis points each time, this might not actually happen. So whether you raise 0 or 25, right, the impact is there already. It's very minimal. Like, you already have a heart attack. You cannot have 2 heart attacks at the same time. So that's my understanding. So the Fed should keep to its word, hopefully. Then we will have more chance to buy, I hope.
What about Bunti though? The last part on the previous one, the entire heart attack discussion.
I think in terms of what they are doing, I think will be very targeted. So it's not like they only have one decision to make, right? So for example, they are using the Fed fund rate to control the inflation, and inflation still high. This one they have communicated quite a few times, and they will continue to check up at least like 25 basis point in the coming one, and then later maybe stay high, not cutting rates soon. That's on the short rate to tackle the inflation. But on the banking crisis, and I think mostly the heart attack part is not like the like profitability or solvency issue. It's mostly a liquidity issue, and they are taking care of that liquidity issue using the BTFP. That means they're lending out funds to the banks, and if they need to pay their depositors, they are able to pay. So liquidity wise, I think with this kind of support coming from Fed and coming from the big banks like JP Morgan and so on, I think they should be fine. And if they are not fine, it's not going to be like a huge collapse and then just like causing contagion, right? It will be just buy out by another big banks. And then I think business go as usual. I don't think there are much conflict. At least what they have been doing in the past, let's say 1 or 2 weeks, is the thing that they will do over the next, let's say, 1 or 2 months. Unless you really like you have another big bank that have a big issues, then different story. But as of now, confined within regional banks, I don't think that is that big of an issue now.
Okay, I hope that provide a good conclusion to this entire discussion of Credit Suisse basically getting acquired by UBS and how it's going to affect the markets in general. So we hope you guys enjoyed the discussion, and we'll see you guys next week. Goodbye.